Hey, what's up, everyone? We've got another fresh episode for you today of our earnings weekly recap. This time, we'll be quickly running through reports from some of the big dogs in Amazon, Microsoft, Apple, and Meta, as well as a couple of big chip stocks in AMD and Intel. It's going to be a crazy one because we've got some huge price movements this week, a lot of volatility. So let's not waste any time. I can't wait to run through these reports with you. Let's go ahead and jump straight into it. All right, now first up here from the big tech giants, we had Microsoft report, who I thought did pretty well as usual. I mean, they pretty much always beat analyst estimates, and this time was no different with an albeit small beat on both the top and bottom line, but most importantly, their year over year numbers were absolutely fantastic with revenue growth of 15% on almost $65 billion in a single quarter alone. That is absolutely insane to still be growing like this at that size. And even their net income profits were also about a double digit growth rate at 10% on over $22 billion. So just crazy numbers coming from Microsoft as usual. And yet, typical Wall Street, they actually sent the stock a little bit lower because of a small miss on cloud, which, by the way, just to show you how little sense this really makes, Microsoft is the second largest cloud provider in the world, and yet their sales for Azure, their cloud platform, it still grew by a massive 29%. But Wall Street wanted 31%, so the stock fell almost 5% this week. It's pretty funny. Now, granted, Microsoft was already trading at a record high, so at this point, it just kind of doesn't leave a whole lot of room here for upside unless you're beating estimates by a giant amount on every category. But I do think that this little dip here is a buy. But then again, I'm a little biased because Microsoft is my number one largest holding, and I think it's always a buy on any little dip, especially if I'm thinking long term. But anyway, take that how you will. The rest of their earnings were just fantastic, though, in my opinion. By the way, Google was they have a smaller cloud platform, and they grew their cloud by 29% in the quarter. So it's pretty crazy that Microsoft is still growing like a smaller player, yet they're so much bigger. Plus, you look at their businesses broken down by quarter, and Azure has been consistently growing by around 30% every quarter, pretty much forever, which is in large part thanks to all the advancements that they've made with artificial intelligence. And I would probably argue that Azure has the most complete offering of AI features and services out of really all the big cloud platforms out there. And management spoke to that on the call, saying that their share gains have accelerated this year, driven by artificial intelligence. And that demand is so high for their AI services that it's literally higher than their already massive capacity. That's pretty wild. Anyway, other parts did really well too. Dynamics, cloud services, Office commercial, search, advertising, server, Windows commercial, all growing by double digit percentages. And then kind of my favorite like little sleeper part of it was Xbox, Microsoft Xbox gaming, that has now grown by over 60% in each of the past 3 quarters. I love to see that. I think Game Pass is going to be really big in the future. I think it has the potential of being the next like Netflix of gaming, as Microsoft as a whole already has over 500,000,000 monthly active gamers, and that's extremely impressive. So add it all up, a great report from them. Analysts agree with me too. A lot of buy ratings coming out of it despite the stock dipping a little. By the way, many stocks did fall a bit at the end of this week though because of macroeconomic concerns. Economy again is just not doing well. It's been like that for a while. So that did probably play a little bit of a factor too in dragging Microsoft a little lower, but overall, again, I just think Microsoft, very solid long-term stock to own. Moving on, though, to the next big tech giant here to report this week, we had Meta, who posted an even better beat on both the top and bottom line, and have also beat each of the past 4 quarters too. So a pretty good trend there coming from Meta, which initially sent the stock climbing on also upbeat guidance, and what looks to be their huge AI investments really starting to pay off for them now. And that's something that I've really said for a long time now, is that look, Meta is pouring a lot of money into AI, but I think it is going to help them long term. And that's what it looks to be happening now. On the earnings call, CEO Mark Zuckerberg, he noted that the company's AI is improving recommendations and helping people find better content that is more relatable to them, which of course advertisers love to see because it makes their job so much easier and more effective, easier to target the right audience. And because of that, advertising revenue has been, advertising business has been pouring into Meta, and revenues in total for the period, it soared by 22%. It's up now to more than $39 billion. It's incredible. And net income, you thought that was crazy. Net income profits skyrocketed by over 70%, up to more than $13 billion too. So just incredible what's happening with Meta here. Again, this is something that I've often said for a long time here about Meta. They are so incredibly powerful and profitable with their social media platforms like Instagram, Facebook, and so on, that they can really afford to take on these type of heavy investments into other ventures like AI and even the metaverse, so that they can really remain relevant longer term into the future. And that's something that I just feel they have to do. You can't just rake in all of this money and do nothing with it. That's how companies gradually become irrelevant over time. They eventually start to disappear. So I applaud Meta for the moves. I think it's the right thing to do. Use that money, spend it. And that's what we're seeing happen here with AI especially, and they're reaping the rewards now. With that said though, Metaverse alone has been taking up a lot of their investments, and some people are not too happy with it, as the Reality Lab segment, which contains the metaverse investments within it, well, it is at least posting a few $100 million in revenue per quarter now, but the total losses since 2020 have been about $50 billion. And that's been a huge pill to swallow for investors. It's why the stock has been so volatile since then. And many people still would not touch this stock with a 10-foot pole. But I just think that the investments are worth it, especially into AI as a whole, and I continue to own this stock long term myself. Speaking of which, it climbed about 5% for the week to now about a record high. But the interesting thing about it is that the valuation is still pretty attractive, with a PEG ratio that is over 17% cheaper than the sector, if you can believe it. And that just really shows how profitable they are and how that's expected to continue into the future. And that's what helps drive down that valuation. And I think still leaves Meta as a pretty attractive stock. Up next, so we had Amazon, one of my absolute favorite stocks in history, really. And they were a bit of a different story here in this quarter, as the stock actually fell close to 9% this week after they missed on revenue and provided lower guidance than expected. The funny thing, though, is that I care much more about their profits at this point. Amazon is a type of dominant company that I never have to really worry about. They're going to remain dominant. They're going to find new ways to tap into growth for sales, new markets to enter and take over. So I'm not worried about the revenue side of things. And by the way, I'm not worried about profits either, because I know that these higher cash profits will come over time. As a long-term investor, I am patient enough to wait for that. But I just think that it's funny here that sales barely missed by half a percentage point, while profits destroyed analyst estimates by over 23%. That's something that people have always complained about Amazon, right? This is not profitable. It's not going to be very profitable. Well, they destroyed estimates by over 23%, and yet Wall Street actually sold the stock down. That's wild to me. Anyway, mind you guys, this is a company here that is doing now almost $150 billion in revenue per quarter. So what the fudge else does Wall Street want from this company? I mean, they're just on fire. And look, I get it, the stock is trading at near an all-time high, but still, I've always felt like people underestimate Amazon because of how much the stock has climbed, and yet, it's still smaller than Apple, it's smaller than Microsoft, it's smaller than Nvidia. Those companies are, $3 trillion market caps or more each. Amazon is still less than $2 trillion. I actually think that Amazon should have been the first $3 trillion market cap company, but that's actually not the case. And to be worth so much less than like Nvidia, that's pretty crazy to me. Anyway, back to the report. Cloud actually beat estimates. That's a great sign for still being the largest provider there. Advertising slightly missed. That could be better. And they're projecting revenue growth of around 10% in the current quarter, which I think is great. but it missed estimates from analysts too. CNBC notes too, though, that competition is heating up, especially from Chinese discount rivals like Temu and Shein. I don't know how to pronounce that, but that's apparently a big Chinese rival. While Amazon's online store sales only grew by 5% year over year, which management pointed to the weaker macro economy for, as consumers are choosing to buy cheaper products, which lowered their average selling price. But I would argue, what do you expect? I mean, the economy is doing pretty bad right now. Inflation, interest rates continue to weigh on consumers. They're through the roof. So, of course, consumers are going to choose cheaper products. It's going to drive down the average selling price. Not much of a surprise to me. And it's not a concern either as a long term investor in Amazon. The fact that their most profitable segment, cloud, is still growing by almost 20% and it topped estimates despite being the market leader, that is a very positive sign. I think Amazon is still a great stock to own long term. And I definitely think that it's a buy on any dips. Lastly, of the big dogs, though, we had Apple report, which I'll be honest with you guys, while I do own the stock myself, a small position, but it's easily my least favorite of the big tech giants. And I have not been buying any of this stock for a while now, and I don't plan on adding any more. It's not that I think it's a bad stock by any means. I still plan on holding it long term, but I do think that it is way overpriced at this point. And I just think the other tech giants like Microsoft, Google, and Amazon should be trading actually higher than Apple, even though that's not the case. The biggest reason why I feel this way is that I just don't think Apple is very innovative anymore. I mean, I've seen people praising this as an AI stock, but I can't really understand why. I mean, they're just adding AI features to their products like iPhones and stuff. It's not going to really move the needle in terms of driving new giant growth for them. It might help a little bit on services, and we are seeing services still perform well, but iPhone sales still make up the vast majority of their business, and yet it actually declined in the quarter, while overall revenue is only crawling at a slow single digit pace in terms of growth. So I'm not really sure what's so exciting about Apple that it deserves to be trading at such a high market cap. And because they beat estimates on sales and EPS along with most categories and put up double-digit growth in services, like I mentioned, though, the stock actually rose this week. It is near an all-time high still. And it's literally the most valuable stock in the entire world at over a $3 trillion market cap. If I was going to say something, I guess, positive about Apple, I guess I would say that I still hold it long term because of how profitable they are. They have a ton of cash. They have a very sticky ecosystem. They can afford to invest in new innovations, even though I don't really feel like they do, but they can if they wanted to. And they buy back a ton of stock. And so there are reasons to just kind of hold the stock. I just don't think it should be worth as much as it is. I don't think there's much growth to be had for the future. And I just think the other tech giants are better buys with my money at the moment. So that's just kind of how I feel about Apple. With that said, though, the last couple of stocks to finish up here, we had two chip giants in AMD and Intel, who also reported this week but had very different outcomes. AMD put up a pretty good showing with the stock initially rising on their earnings beats, as well as some geopolitical tailwinds that may help them in the future before reversing course, which I'll touch on in just a second. But they just posted a slight beat on EPS, which was a huge recovery on net income year over year, while also guiding for a little more in revenue this quarter than what analysts were expecting. AMD is, of course, the second largest vendor of discrete GPUs, only behind NVIDIA, which of course have soared in popularity thanks to AI and the data center. And yet NVIDIA stock actually more than doubled this year, while AMD has been negative. But it looks like AMD is starting to make some greater progress there, as CEO Lisa Su noted higher than expected demand for their AI chips in the quarter, and they are having to raise their guidance for data center GPUs by $500 million as a result. Also noting that their data center segment, which includes AI chip sales, more than doubled year over year because of that rising demand. Geopolitically, AMD and other American chip vendors may also experience a new tailwind in the future, as Reuters is reporting now that the US will exclude allies like Japan, the Netherlands, and South Korea from a recent export ban on semiconductor related equipment. And yet the stock actually fell for the week. which was a little surprising. But the entire sector really got beaten down heavily towards the end of the week because of macroeconomic reports about the economy doing worse than expected right now. So that's kind of what dragged it down a bit. Plus, you also had Intel report some horrendous numbers that we'll jump into in just a second. But overall, AMD stock fell about 7% for the week. And while it is still up over 3,000% in the past decade, it is also down over 30% from the top. I actually do kind of like AMD at these levels. I don't own it myself. I used to. I made a lot of profits on it. But I right now have a huge position in NVIDIA. And I also have a small speculative position in Intel. But AMD does look good too. I can definitely understand owning that one. Speaking of Intel though, the stock had a horrible showing, falling by over 30% just this week alone, leaving it now trading for literally the lowest price of the past decade and down close to 70% from the top. It is really crazy just how much this company has, I would say, deteriorated over the years. Now, of course, much of this is due to the rise of NVIDIA and AMD, with their GPUs being heavily used for AI and data center, while Intel CPUs have been less popular. And they've also dealt with countless issues manufacturing their own chips, which looks like the issues just continue to weigh on them. This quarter resulted in them missing estimates on both the top and bottom line, while also announcing that they will cut their dividend and lay off 15,000 workers, which is an unbelievable amount. And for sure, prayers and thoughts and heart goes out to all those workers losing their jobs. Definitely don't want to see that. So, what is causing all of this? Well, I dug into the report a bit here, and really the two things that stood out to me the most were the foundry business and their Altera business. Now, foundry is huge for them because that's where they build their chips. That's that segment. And of course, that's been taking on a huge expansion recently because of the American subsidies and tax incentives, and the West just in general kind of trying to rely a bit less on Asia for their chip manufacturing. So there are some tailwinds there. However, those tailwinds have not really materialized quite yet, and it might take a couple more years until we really start to see the benefits from it. But as it stands, Foundry is losing tons of money for Intel, with the last 3 quarters showing sequential declines in both sales and operating income. On top of that, their subsidiary Altera, which makes custom programmable chips for areas of telecommunication, automotive, aerospace, and defense, and even the data center, it saw a 57% crash in sales year over year. But the interesting thing is that everything else was positive for Intel. Total Intel products was actually up 4%. So it's really just these two areas that I feel are really weighing down on Intel the heaviest, and that's what's kind of dragging them, and it's what's hurting them a lot. To which management did at least address these concerns in the earnings call. They said that the foundry business was expected to peak in losses this year, and it should eventually start recovering from all the incentives, to which they actually think it will generate considerable earnings growth long term. Also noting that some big companies are even enlisting Intel to build chips for them, notably Microsoft, who already has $15 billion booked in for sales for Intel. They also noted that Altera is rebounding this quarter, and they're optimistic that it will see a good year in 2025, noting that much of the losses being experienced right now are also due to capacity moves and restructurings of the business from factories that aren't being utilized effectively enough to ones that are operating more efficiently. But look, at the end of the day, they'll say whatever they need to say to bring back investor confidence. But the point is that Intel just has not been competing effectively enough with NVIDIA or AMD for years now, and that's really hurt them. They've lost market share, especially on the CPU side, and they have not been competing nearly as well enough as NVIDIA on the AI side of things. So they really need to start fighting back with some innovative products if they want to survive. Time will tell if that happens. I'm not sure that laying off so much of your workforce is going to get that job done for you. But if I'm trying to be more optimistic about Intel, I would probably argue that, as unfortunate as it is, cutting so many workers should help you save some money that can be used for investing in more innovative products, help you run leaner, more efficiently, help you survive. And then most importantly, cutting that dividend. I mean, that dividend, I could not care less about that dividend. Get that dividend out of there, because you're going to need as much of this money as you can get your hands on in order to compete with NVIDIA and AMD. So hopefully start releasing more innovative products, which they are, to be fair, starting to do. They're entering discrete GPUs. I don't know how that's going to turn out, but right now, AI accelerator custom chips, these are new chips that they're making. That looks to be a lot more promising. Gaudi 3 is their newest one. It's getting praised a lot for price and performance compared to Nvidia, and they're aiming to ramp that up in the second half of this year and going into the future. So we'll have to see how that starts to perform. If that does well in sales and they can really build off of that, that would help a lot, help Intel recover a bit. Right now, I guess my overall conclusion on Intel is just that it's a stock that obviously the company is struggling, but the stock has crashed by so much. It's very kind of unbelievable. And the valuation is 70% cheaper than the sector, despite them still being a market leader in CPUs. So I just think that there is some promise here for a recovery for Intel. Again, we'll see how it turns out. It's only a small bet by me. It's a small kind of speculative bet by me. But and of course, I have way more money in Nvidia, but I still just kind of want to have a piece of Intel because I think they are going to matter for America and the West becoming less chip reliant on the East or on Asia and stuff like that too. So I think there's a lot of ways that Intel could recover, but we'll have to see if those catalysts actually bear some fruit for Intel. Anyway, thanks for stopping by, my friends. I hope you enjoyed this week's earnings update. Hope you enjoyed it. Let me know down below if you have any questions or any thoughts on anything we discussed, and I will catch you in the next video. All right, take care, everybody. Bye-bye.